Hi everyone, this is a video about self-managed super funds versus industry super funds. And it's a part of a series of educational videos for private investors like you that brings out some important issues that arise in managing your investments and building your family's wealth for the future. So self-managed super funds versus industry super funds. Let's take an example. Mary and Faiz, a few years ago, opened a self-managed super fund on the advice of their accountant. Their accountant charged them $3,000 to open the SMSF, and now their accountant charges them $3,500 a year for the tax and audit of their self-managed super fund. They've been thinking whether that's money well spent. They've been hearing the comments coming out of the Productivity Commission and then the Royal Commission last year about how many people have self-managed super funds who really shouldn't, who don't get value from it. That of the 600,000 self-managed super funds, perhaps 350,000 shouldn't exist. That those people should really be in industry funds or retail funds or government or corporate funds. And here we're talking about the alternative for Mary and Faiz being one of the best industry funds, industry super funds such as Australian Super. So they're weighing up the pros and cons, and let's have a look at what they are. So for self-managed super funds, the main benefits are control. You need control if you're going to get the total benefits from active management of a self-managed super fund, as I'll show you in just a moment. And also business-related property. There's a tax strategy associated with that, which I'll also explain in just a moment. In regards to industry funds, the advantages are about higher returns, which comes from their ownership of private assets, but also their low-cost model and just the little effort that it requires to have an industry super fund. So let's have a look at these in succession, starting off with control. So if you want to be active in the management of your self-managed super fund, then to take opportunities, you need control. And those opportunities might include participating in the buyback of shares when companies like BHP and Rio Tinto and Telstra buy back their shares. That can make money for some investors. Participating in initial public offerings when private companies list on the stock market for the first time. If you can get an allocation, that can be quite lucrative when the shares pop up in value on the first day. It might also be that there might be some private equity or venture capital opportunities brought to you by your advisor, which you can only take if you have control of your own super fund. Then there's issues to do with leverage, issues to do with you managing the risk of your portfolio by using instruments like puts and calls, options, short selling, and also some tax issues that you can have control over the realization of capital gains. But we really shouldn't overstate those advantages. That sounds like a long list and it sounds fantastic, but you really have to be very active. And in any case, we shouldn't understand how much extra value you can create from that control. But people do value it who are very active in the management of their self-managed super funds. Now, I think a more important thing is business-related property. Now, let's have a look at this in some detail. If you own a business and you have a self-managed super fund, then commercial property that is used in the running of that business can be owned in the self-managed super fund. And the self-managed super fund can lease the property to the business and receive the rent. And then cash is flowing from the business into the self-managed super fund. Now, the self-managed super fund can borrow money from a bank to help to finance the purchase of the property at the beginning. And we can see why this is so advantageous when we think about concessional and non-concessional contributions to super. So we can see in the diagram that salary comes from the business, and from before tax, out of the salary before tax, comes the concessional contributions, up to $25,000 per year. And then, of course, people can make contributions after they paid income tax, which are the non-concessional contributions, up to $100,000 per year. But there's limits on how much you can put into your super. In any case, once you get to 1.6 million, you can't put any more in. 1.6 million is a chunk of change, but nonetheless, many people will hit that limit eventually. And that limit and the concessional and non-concessional contributions don't affect money flowing into the SMSF through the leasing of property owned by the SMSF to the business. So this is a very important strategy tax management strategy for many businesses, and it's very common for small and medium-sized businesses to own property related to the business in their self-managed super fund. That's a good reason for having a self-managed super fund. Let's turn to the industry funds now and think about what the advantages are in industry funds. So a principal advantage is higher return. And what's the source of that higher return? Well, it's from the ownership of private assets. When we look at the balance fund here, we can see that there's 7% of the balance fund invested in direct property. There's 12% in infrastructure, which is a fantastic asset class. And there's 4% in private equity. Now, especially with infrastructure and direct property, and especially with infrastructure, that's hard to get to with your self-managed super fund. It's difficult to invest in infrastructure, even though it's a fantastic asset class, which performs well in so many different circumstances. Yes, you can own shares in Sydney Airport. Yes, you can own shares in Transurban. Yes, you can own shares in AusNet, but that's not the same as the direct ownership of infrastructure that the big industry funds have, and it's a terrific advantage. We can also see in this diagram at the bottom that the fees are low. 60 basis points, 59 basis points for the high growth option in Australian super. That's low comparing to hiring someone to manage your self-managed super fund for you. If you do that, that's going to cost you about 100 basis points per year. Or you might want to save the money and do it yourself, but that's a lot of effort. So industry super funds, high return, low fee, low effort. And that's a lot. And that's actually causing quite a lot of people. And in the end, it causes Mary and Faiz to decide to shut their self-managed super fund and to go to an industry fund. But there's good reasons for having a self-managed super fund. But unless one of those reasons applies to you specifically, you should be thinking about doing what Mary and Faiz are doing. Now, I should say that this discussion of structuring and tax planning comprises a significant portion of my investments course. So when I say structuring, I mean the ownership of assets and the streaming of income through legal structures such as self-managed super funds, family trusts, corporations, the involvement of corporate beneficiaries, corporate trustees, etc. In my investments course, all of those things are explained completely, what they are and how they're used. So the Finance Education for Investors course is a comprehensive course on personal investing. It starts from the beginning, so no prior knowledge is needed, but it treats all the important topics in depth. It's not mathematical, but it gives investors the investment philosophy, the knowledge and processes to be empowered in their investing and to get to much better outcomes. It's education and not financial advice. Now, it runs over 8 evenings for a total of 22 hours. This video runs for about 8 minutes, so imagine how much you'll learn over 22 hours if you take your place in the Finance Education for Investors course. In any case, thanks for watching this video, and I hope you watch the rest in the series.